Hello and welcome back to Refinitiv Perspectives Live. This is episode 10 out of 24 that we're doing today until tomorrow. It's the one with ESG and sustainable investing culture in 2021. Please welcome our guest, Arun Krishnakumar, partner at Delphas International.
Hi, Shahad. Thanks for having me.
Thanks for joining us and thanks for taking the time on such a popular, very, very popular topic. We've heard a lot about it also in previous episodes. It always comes up, the subject of ESG. So since we don't have that much time, I want to directly dive into my first question to you, which would be, when we mention ESG, where do you see the potential for investors and how are you going on about it? Just to get like your personal opinion, your impression of the market, since you are deeply entangled in all this.
Sure. So I don't want to delve too much into my background, but just in the context of the question, I've been a venture capital investor for a good part of the last decade, and that's been my passion all along. But when I arrived in the venture capital scene, looking at the deals happening around me and the deals that are still happening, things that are super hot in the market and all that, there's always something that feels missing for me personally. And that's like almost, okay, you're creating a Clubhouse app, you're investing into TikTok, all these are happening, it's amazing, but what is happening to the farmer in Africa who's struggling to make ends meet? What's happening to the woman entrepreneur in Latin America? So these are the things that are missing, and we are not really looking beyond ourselves, be it as consumers or as investors. You've got to have that environmental consciousness of what impact you're having beyond just your closed community and ecosystem. So that's really where I think the world should be going, and that's where the opportunities are. And if you're looking at it purely from a regional, vertical perspective, by virtue of what we do at Delphas, all our focus is on emerging markets opportunities. We've over the course of the last 30 odd years, we've done over $12 billion worth of financing in emerging markets. And my focus is to leverage that experience and start getting more capital into technology firms focused within the emerging market space. And that's really super exciting, because if you look at some of the deals that come through, it is sometimes, personally, when I have these conversations, and particularly with Indian entrepreneurs, I almost start feeling guilty, because it's like someone comes and tells me, I've done a fintech firm, I've served 50,000 SMEs, I've got them financing. They never used to be able to get that financing, access to that financing. I'm like, what the hell am I doing here? Right? So that's really where I'm personally going with my career, but that's also where the opportunities are. The growth opportunities are amazing. So I'll pause there.
So, when you're talking about your day-to-day, what can you explain maybe a bit more on what is it exactly that you're also doing at Delphas with that?
Sure. So our thesis is this. There are organizations called development finance institutions across the world. And they have been around for several decades now. They've been quite active, especially in the emerging market circles. What they typically tend to do is look for emerging markets opportunities, investment opportunities, be it equity financing or debt financing, mezzanine financing. They look for emerging markets, and more importantly, they also look for the social impact angle. So what Delphas have done is, over the course of the last 30 years, they have basically created this investment banking ability to spot some of these really niche, esoteric opportunities, and we've been more of building that or facilitating the cash flow or capital flow between DFIs and emerging markets opportunities. It is not to say that we don't do proprietary investments. We do, but that's a very small portion of it, and I think that's something we are planning to ramp up through 2021. But at this stage, you can see us as investment banks focused on emerging markets investment opportunities for DFIs, particularly for DFIs. The reason why this this capital is special, especially for, I mean, I come from a technology background, so I'll focus on technology, especially for technology firms. Is technology firms often see VCs as the be all end all kind of space, right? If they want to grow and if they want financing, they have to go to VCs. Without that, there is no growth. At least that's where the world is today. But that's not true. Most of these VCs get their own funding from their DFIs, these DFIs that we work with. So, and these DFIs are now starting to operate in the technology space as well. So, why are DFIs special or better than, or why is a DFI funded route better than a VC funded route? Is because in a VC world, when you go through that kind of a roadmap over a period of time, in 5 years, by the time you get to say Series B, Series C, in a technology in the lifespan of a technology firm, your dilution becomes high. You start to have, you give away a lot of your equity. Whereas in the DFI world, especially if you're an impact firm, ESG line firm, you don't just go for equity. You also have an option to go for debt. So of course you can't have debt in your Series A. You probably need to go for full equity. But the moment you actually have some DFIs on board, they are willing to open up doors for you in the debt space. So that means in 5 years' time, when you're looking at Series C, Series D round, you as a founder, you have like 50% more of the equity in your pocket. So it's in my opinion, it's a no-brainer, but it's not something that's been very publicized in the startup and entrepreneur community. So that is something I'm going to start doing now more often and talk about the benefits of DFI capital. And it's something that's important, which is especially in the ESG space.
Perfect. When you're talking about that, I mean, obviously there will be a couple of challenges and kind of impact on those. What are the on-the-ground challenges in executing impactful business in general and in this real world where it's going to be with the ESG world that you want to see probably also?
I think if you look at, I mean, again, coming from a VC world, what I have always found as a hindrance to be deploying into sustainable impact focused opportunities is that there is quite a lot of focus on just returns, blind returns. And that's humans, right? End of the day, we want to make money, and I would prefer a 10x rather than a 4x as a multiple for my fund. And that's really what's been the challenge in actually getting funding for some of the social impact technology firms. But I think that is going to change over a period of time now. What I find is that there are a lot more investors out there, emerging investors out there, who are specialized in social impact. It's still a minority, a very, very small percentage, but you will start seeing that as a growing trend, where you will see a lot more capital moving into this space, and people willing to take willing to take an approach where you're not just looking at risk and returns as the two axes of investment. You have the third axis, which is the impact axis. So if you're saying that I have to manage my risk returns, you also will start looking at how am I doing on the impact KPIs. So when you start bringing that three-dimensional view to investing, it starts becoming it starts becoming mainstream. I think that's where that's been the historic challenge for investors in that space. The on the ground challenge, of course, is that a lot of these impact use cases have to have some kind of a public private sector kind of a model. It cannot be purely private. It could be, but most of them are public private sector kind of partnership. And there needs to be policy helping helping it through as well. And that's one of the areas where I found it very hard, because it's a slow moving area, which means that investors have to be a lot more patient than they typically have been. And sometimes that can be a little bit capital intensive upfront. So when we go through the journey with these entrepreneurs, that is what we find. But what we are also finding is, to mitigate those challenges, we are starting to see things like more grant money coming onto the table, which helps these entrepreneurs to keep their head above water for longer than if they went down the VC route, for instance, where they need to be throwing out quarterly KPIs, unit economics have to be what the VCs want it to be, and stuff like that. So that's really the challenge for on the ground execution.
I mean, we've also mentioned the time and the time that it's taking to build something up for everyone before they even get like the numbers for investors or anyone else being part of this whole ESG structure and the company that's being built. Where else do you see issues? I mean, do you see people not being patient enough? Do you see people understanding that it's going to take a bit more time? Are they adapting nowadays maybe faster than they have last year?
Actually, a bit of all these things. One of the things I find, especially with the impact entrepreneurs, is most of them have a story on why they are doing something, and they're super passionate about it. They're not necessarily too commercial. And you have to be commercial even if you're running an impact business. End of the day, you have to show that you can make money for the shareholder, and that is one of the challenges I've kind of constantly seen. So we need a lot more mainstream entrepreneurs to go impact, to embrace impact, to say there are profits to be made in this space, and there is huge growth opportunities, and both of these are true. What I also find sometimes is the on the ground challenges, which is, so for instance, I'll give you an example, right? So we are looking at a firm that we're working with a firm who's got I think 20 million grant from one of the large foundations to help women farmers in Africa. So they're now going out there, and the 20 million is not to help them shore up their balance sheet. It is to help distribute the capital effectively to farmers, women farmers in Africa. They go to Ghana, they go to Nigeria, they go to Rwanda, they go to Kenya. When they have these conversations, what you typically see is the men farmers trying to elbow the women out and say, almost create a perception there is not enough women who can actually benefit from that capital. So you see that kind of challenges, the social challenges that creeps in, and which means you have to first, it is not like a technology startup where you just create an app and just pump up SEOs, invest into Facebook's Instagram marketing, and you start seeing growth. It's not like that. There are real on the ground challenges. You have to be on the ground, understand the community, the challenges with the communities, and be able to get through them over a period of time. These are not challenges you can actually overcome in a day or two. It's not like switching on or off. You've got to work with these men and women to say, hey, this is what the mandate is. This is what we are going to do. How can we look beyond just these little differences? How can you benefit from the whole thing? And there's a bit of conversation to be had there, and they have to go through that. So it takes time for these firms to resolve these operational issues and deploy the capital effectively so that the impact that is intended is achieved in the end. I can give you a bunch of other examples as well. For instance, crop insurance, right? So crop insurance has been a major challenge. It's an amazing philosophy, which is if crops failed, the yield from crops fail for a particular year, the farmers get paid for it, right? As if they had the insurance, of course. The challenge with that is when you deploy that kind of a financial product in, say, for example, India, where I come from, the challenge is the corrupt government officials in between. Because when the farmers, even after the failed crops, try to go claim for money, they make it extremely hard for these farmers to get access to the funds. So how can we deploy technology to overcome these challenges? So you could basically, I mean, just taking the India example, you could basically have a blockchain-based solution where you're not relying on any individual to make those claims decision. You can basically capture information on the ground, what do you call it, the moisture levels on the ground, the weather conditions, the target price or the market average price of crop, and based on all these different variables, you can really say, okay, this year this crop has failed in this part of the region, and these are the farmers who've got they have a biometric Aadhaar card, so they have a bank account, they've been paying their insurance, now release the claim so that they get. You don't need human beings in between. So when you have this bureaucracy, and that's typically one of the challenges with the impact stories, when you bring these bureaucratic officials in between, you're going to see all these social challenges, corruption challenges, which I'm hoping technology will help overcome over the course of the next 10, 20 years.
Yeah, the on-the-ground challenges that we just that you just mentioned and explained. I mean, a lot of people don't think about these things probably. That's why it's really nice to hear what you've been facing and what challenges they are, well, coming up within the whole process that most of the people don't see, but you're just getting the result or the end result or the idea. And the storytelling actually, or the idea of it, is actually just the starting point, given what they want to achieve, well, in the future. If we look a bit in the future, mentioning also the past, we have here, I mean, we saw that ESG was boosted in 2008 or by the crisis. Do you anticipate this trend post 2020 or post 2020 crisis as well?
Yes, what we typically see is that it needs crisis to make us do the right things. It looks like, because one of the trends, I've been very close to the Islamic fintech space, at least in the UK, and I see quite a lot of deals on a regular basis coming into my inbox. One of the things I've seen is that there's been a consistent growth within the Islamic fintech, or not just Islamic fintech, broadly across Sharia finance itself, across the world, particularly after 2008, because they also they've kind of started to see that it is not a kind of a belief-based model. It is actually a sustainable model, which is very grounded in ethical financial practices, and a lot of the aspects of Sharia finance, like you don't have interest payments and stuff like that. You don't deploy monies into you don't deploy money into gambling, and all the other verticals which are not considered ethical. These are all sustainable themes that the world should embrace. The challenge is that when you go through that process, or that the financial modeling around using these ethical rules, almost, you tend to create opportunities for yourself. You tend to create products which do not give you the same yield as the mainstream financial products, and which means you have to really think your products ground up. And again, I have to bring one of my portfolio companies here. I'm not trying to do sales here, but for them, but for instance, my portfolio company, Yielders, this is they Irfan Khan, who is a second gen UK based Muslim. He's been able to think through or bring together the Sharia finance aspect and the financial knowledge he's gained from being in the UK, and created this platform which looks at the real estate investment angle ground up. He's created a product where crowdfunding could be done in a very Sharia compliant way, and at the same time he's also got FCA approval for that. So you can actually bring these two together, and he's giving them the investors are getting very good yield out of what he's created. It's very, very market competitive. So you can do it, and you've got to be able, and you're going to see a lot of these themes come together with the post crisis pivot that the market is taking. And you slap the technology slap technology around it, and you have these entrepreneurs who are thinking above or outside the box. You're going to see some amazing, cool, sustainable impact stories coming out. One of the things I've been reading up on this as well, called psychological capital, which has been a very recent term. It basically looks at a bunch of themes, if you like, which is you've got to have resilience, you've got to be able to have the right ethical aspects of doing business. You've got to be optimistic, and you've got to have self-efficacy, as they call it. And when you have all these things, you tend to be a very impact-focused person as a human being. And what they're starting to see is, as an organization, when the psychological capital is high, and they measure it using various indicators. When the psychological capital of an organization is high, the success probability of the organization is high as well. And that's been a very recent, it's been a 2020 research that's out there. What you also can expand from that that particular concept is that psychological capital is not just about organization. A society is an organization, a government is an organization, and a community that we all make up is an organization. If we all have psychological capital, high levels of psychological capital, we are all going to drive the world towards a sustainable future. And that's really what we should be driving towards as human beings. So I think that's really what needs to be coming out of crisis. And crisis tends to actually help us think through these things, gives us some points of reflection to say, okay, what went wrong, why did it go wrong, what can we do better next time? I mean, this time probably it was an event-driven crisis, which is the COVID crisis. But the last time it was a proper structural crisis. There were serious, greed involved. There was serious mismanagement involved, regulatory breaches involved, and of course, large levels of corruption in some sense. But when you go through that, you tend to find that the market pivots towards something else, and even the right.
What's possible also, or that it is possible to change something.
Absolutely. And with this, especially with COVID, what it has given all of us is perspective towards what's more important in life. Like, for instance, we have taken our health for granted for a long time. We don't do that anymore. We've taken our mental health for granted for a long time. And again, that's going back to the psychological capital aspect of it. There is a lot of focus on mental and physical well-being of people, or part of or people who make up an organization. And when we look after that, the organization tends to kind of thrive. And that's really
this is what's been changing also within the smallest and mid-sized companies also, as well as not just the big ones that are thinking about the mental health and the health itself from their employees, but also their own now, and not just the management, but it's then everyone included to keep this company driving. And in terms of ESG, it's exactly that. I don't want to say too many companies, but in general, people have been missing out on a little bit, or not putting enough focus on. Maybe that's, we're forward to change something, but probably this is the way we can hold on to within the future.
Yeah, absolutely. In fact, mental health, I mean, at least in the startup space, it's super essential, because startup entrepreneurs are being viewed as people who can just keep going. Just keep going. Doesn't matter. You can take all rejections. Just keep going. If you can't go, you are weak, right? It cannot be that. We are all human beings. We all have breaking points, and you have to work with that mindset as an investor, as a board member, and be able to support the entrepreneurs in a way that they're really looked after. And one of the things I keep telling people who we have these conversations all the time is, people who don't realize that you have to look after your entrepreneurs, and your returns on from the company is more important. You're really missing the point. You've got to be focused on the duck that lays the golden egg, not the golden egg. It doesn't make commercial sense to be focusing on just one investment when you have an entrepreneur doing amazing job, and for some reasons the output is not coming through. It doesn't mean you just pull the plug all the time. You can actually keep supporting them, and probably, if not in the first startup, they will click it or they'll make it happen in the second startup. It's always about the people, and that is starting to come through. Some parts of even Silicon Valley is actually starting to wake up to the fact, and definitely in the UK, I've seen several conversations around mental health, which is really nice.
Yeah, it really is super nice, and it was also very nice having you. I very much appreciate you taking the time to talk us about through this whole subject of ESG, and I would love to hear or welcome you soon to one of our episodes if possible. So thanks for the time, and thanks everyone also for listening. If you enjoyed this episode, you can now watch or listen to our ESG products by scanning the code or going to the link on the screen now. And as always, thanks you for joining, and be sure to stay tuned for the next episode on the hour. So in about 35 minutes. See you soon.